Good day to everyone. In the last video we learned what is mutual fund, their advantages and disadvantages. In this video we are going to discuss about how the mutual fund schemes are classified. Let's learn. Mutual funds are available in different types to suit different investment goals and risk profiles. They can be classified based on their organization structure, such as open-ended, close-ended, and interval funds. Based on portfolio management, they can be actively or passively managed. Depending on the investment objective, schemes focus on growth, income, or liquidity. They are also categorized by the underlying portfolio, including equity, debt, hybrid, money market, and multi-asset funds. In addition, investors can choose solution-oriented funds for goals like tax saving or retirement, thematic and sectoral funds, exchange-traded funds or ETFs, overseas funds, and fund of funds. Understanding these categories helps you select the right mutual fund that aligns with your financial goals and investment horizon. Let's begin by understanding the organization structure of mutual fund schemes. Based on how investors can buy and redeem units, mutual funds are classified into three types. Open-ended funds allow you to invest or redeem on any business day, offering maximum flexibility. Close-ended funds accept investments only during the new fund offer, or NFO, and the investment remains locked until maturity. Interval funds combine features of both, allowing transactions only during specified intervals announced by the fund house. A simple way to remember this is an open-ended fund is like a supermarket, a close-ended fund is like a movie theater, and an interval fund is like a train that stops only at scheduled stations. Understanding these structures helps you choose a scheme that best matches your liquidity needs and investment goals. Let's look at how mutual funds are also classified based on how the portfolio is managed. There are two types: actively managed and passively managed funds. In an actively managed fund, a professional fund manager continuously researches the market and actively buys or sells securities with the aim of outperforming the benchmark index. In contrast, a passively managed fund simply tracks a benchmark index by investing in the same securities in the same proportion. A simple way to understand this is to think of a personal chef versus a recipe book. The chef actively makes decisions to create the best meal, while the recipe book is followed exactly as written. In short, actively managed funds aim to beat the market, whereas passively managed funds aim to mirror the market. Now let's see mutual funds are also classified based on their investment objective. Growth funds primarily invest in equities with the aim of creating long-term wealth, making them suitable for investors who can handle market fluctuations. Income funds mainly invest in debt instruments to generate regular income with relatively stable returns. Liquidity funds, on the other hand, invest in short-term money market instruments, providing quick access to money while preserving capital. Think of it this way: a growth fund is like planting a mango tree for future fruits, an income fund is like owning a cow that gives milk regularly, and a liquidity fund is like keeping money in your wallet, always available when you need it. Choosing the right investment objective depends on your financial goals and investment horizon. Let's look at how mutual funds are classified based on their underlying portfolio, which means the type of assets they invest in. Equity funds invest mainly in company shares to create long-term wealth. Debt funds invest in fixed income securities and aim to provide relatively stable returns. Hybrid funds combine equity and debt to balance growth and risk. Money market funds invest in short-term instruments, making them suitable for managing surplus cash with high liquidity. Multi-asset funds invest across multiple asset classes such as equity, debt, and gold, providing diversification through a single investment. Think of it this way: equity is like growing an orchard, debt is like earning rent from a property, hybrid is like combining a business with savings, money market is like keeping cash in your wallet, and a multi-asset fund is like eating a balanced meal. Each serves a different purpose depending on your financial goals and risk appetite. Solution-oriented mutual funds are designed to help investors achieve specific long-term financial goals. These include tax-saving funds, retirement funds, and children's funds. ELSS or equity-linked savings schemes provide tax benefits under Section 80C while helping build long-term wealth with a mandatory 3-year lock-in period. Retirement funds help you accumulate a financial corpus for life after retirement. Children's funds are meant to build wealth for your child's future needs such as higher education or marriage. Think of these funds as goal-based investments, saving tax today, securing your retirement tomorrow, or planning for your child's future. They encourage disciplined investing and help you stay focused on your long-term financial objectives. Exchange-traded funds or ETFs are mutual fund schemes that trade on stock exchanges just like shares. Most ETFs are passively managed and aim to track the performance of an index commodity or a basket of assets. Equity ETFs track stock market indices. Gold ETFs provide exposure to gold without owning physical gold, and debt ETFs invest in fixed income securities. Think of an ETF like buying a ready-made shopping basket instead of purchasing each item individually. And because ETFs are listed on stock exchanges, you can buy or sell them anytime during market hours. In short, ETFs combine diversification, flexibility, and relatively lower costs, making them a popular investment choice for many investors. Let's explore how overseas mutual funds allow investors to invest beyond Indian markets by providing exposure to international companies and economies. These funds can invest across multiple countries through global funds, focus on a single country through country-specific funds, or track international benchmark indices through international index funds. Think of it like traveling. A country-specific fund is like visiting one country, while a global fund is like taking a world tour. By investing internationally, you can diversify your portfolio and participate in the growth of global businesses. However, returns may also be affected by currency movements and global market conditions, so these funds are generally suitable for long-term investors seeking international diversification. Here is the interesting scheme type. Unlike most mutual funds that invest directly in stocks or bonds, a fund of funds or FOF invests in other mutual fund schemes. This provides an additional layer of diversification through a single investment. There are three common types. Domestic fund of funds, which invest in Indian mutual funds. International fund of funds, which provide exposure to overseas markets. Asset allocation fund of funds, which combine different asset classes such as equity, debt, and gold. Think of it like buying a gift hamper instead of purchasing each item individually. Everything is already selected and packaged for you. In short, a fund of funds simplifies investing by giving you access to multiple professionally managed funds through a single investment. Let's now understand thematic and sectoral mutual funds. Sectoral funds invest in companies from a single industry such as banking, IT, or pharmaceuticals. Since the entire portfolio depends on one sector, these funds can be more volatile. Thematic funds, on the other hand, invest across different sectors that are connected by a common investment theme such as manufacturing, infrastructure, or ESG. Think of it this way: a sectoral fund is like owning a mango orchard. Your success depends on one crop. A thematic fund is like a fruit basket. It contains different fruits but all follow the same theme. In short, sectoral funds provide focused exposure to one industry, while thematic funds capture opportunities across multiple sectors driven by a common long-term trend. We have now learned how mutual fund schemes are classified in different ways. One important takeaway is that there is no single best mutual fund. Every scheme is designed with a specific purpose and is suitable for different financial goals, investment horizons, and risk appetites. The key to successful investing isn't choosing the most popular fund, it's choosing the fund that aligns with your financial journey. Hope you like this video. Like and subscribe.